Hi, my name is Jatin Khemani and I run an independent equity research firm by the name of Stalwart Investment Advisors based out of New Delhi. We are registered with SEBI as investment advisor. I blog at stalwartvalue.com/blog. Before I get to the presentation, I want to briefly discuss what really drives long-term returns. So broadly, there are two components. One is earnings growth and the another is re-rating. Let's assume we are investing in a small emerging company and we are among the first lot to identify the potential in that company. And we bought it at, let's say, 15 PE. Over time, as business delivers, the story gets known, it is bound to get re-rated to 30, 40, even 50 PE multiple. But would it be fair to assume an exit multiple of that high? Obviously not. As growth tapers down, the multiples are bound to contract. Over time, multiples will revert to mean, which makes re-rating not a very sustainable and consistent driver of long-term returns. Coming to earnings growth, there are three subcomponents. Let's first discuss financial deleveraging. So if you had invested in a company which has a lot of debt on the balance sheet and over time it repays it, there'll be interest cost saving which will go to profit. Now this can only play out once. What about margin expansion? So good companies should have pricing power. Pricing power means margins can expand, and there are a lot of great companies out there which can double their profit margin overnight. But would it be wise to do that? It's always a trade-off between near-term earnings versus longevity. When margins expand too much, it is bound to attract a lot of competition too, which again makes margin expansion not a very sustainable and long-term driver of return. Which leaves us with the final driver, which is sales growth. Now, I believe out of all the ones which we have discussed till now, sales growth is one which is the most consistent and sustainable driver of long-term returns. So if imagine we are, we are a long-term investor and we want to invest for next 5, 10, 15 years and our hurdle rate is 20%. If you assume other drivers are not going to contribute meaningfully, then essentially we are saying that sales should grow at least at 20% CAGR. But the challenge is that our economy in terms of nominal GDP is growing only at 12 to 14%. Then how do we find industries that can grow at 20% plus and in turn companies? There are industries that are growing at 20% plus, but most of them are sunrise sectors like e-commerce, where rate of change is very high, and most of them are unlisted. However, if we look back, there are some great companies which have delivered very high rate of growth in terms of sales over a long period of time. Case in point, Page Industries. So in 2006, this company had a 100 crore top line. Last year, it did 1800 crores, which translates into a CAGR in terms of sales growth of over 37%. Now, what's fascinating is that this is on the back of an industry that grew only 10% in the same period. What really contributed to it? Look at the share of unorganized in 2006. It was as high as 65%. Today it is down to 52%. Let me share one more example. Relaxo Footwear. In 2006, the top line was 200 crores. Today it is 1700 crores. CAGR of 27%. On the back of an industry growth which was merely 11%. Share of unorganized was as high as 70% in 2006. Today it is down to 50%. Before we proceed, let's discuss what really unorganized sector is. So if you go to Wikipedia and look for the term unorganized sector, there it's defined by National Commission of Enterprises as those consisting of all unincorporated private enterprises owned by individuals or household operating on a proprietary or partnership basis with less than 10 total workers. The common features would be ease of entry, small scale of operation, local ownership, uncertain legal status, lack of good storage facilities, no brand name, no effective distribution network, regional player. However, for the purpose of this research, we're going to keep revisiting this definition and we'll have our own version of this for each sector we discuss. How is it different from organized sector? So when it comes to organized sector, they'll have a brand name, which will make sure, there is familiarity, there is trust. They would have a large distribution network. They would have standardized offering. And because of the huge scale, the per unit cost would be lower. Whereas in terms of unorganized sector, the strategy is to have cheaper pricing by way of evading taxes, by way of having an inferior quality product. And the sales strategy is not brand pull, but brand push. So they'll give higher margins to dealers so that dealers have more incentive to push their products. Today, 40% of India's GDP is contributed by organized sector, and 60% of it is still contributed by unorganized sector. So when I look back at Page Industries and Relaxo, I had both the stocks in my portfolio. I still continue to own Relaxo. So when I look back at those stocks and the story and what trend played out, I couldn't help but ask myself which are the other industries where the similar trend is playing out or can play out in future. So I've applied 3 filters. Industry size should be more than 2000 crore, which makes sure that size of the opportunity is large enough. Second, the industry should still be growing at 8% CAGR, which makes sure that size is not only large, but it's a growing pie. And finally, share of unorganized should be more than 40%, which is the theme of this entire consolidation wave. So let's discuss the first industry, apparel. This is a huge industry in India, worth 1 lakh crore, which implies every year ready-made garments worth 1 lakh crore are sold in our country. The industry is still growing at 8% per annum, which is very healthy. And the share of unorganized is 70%. Top 3 brands in India have a cumulative sales of less than $1 billion. Contrast that with China, where a lot of homegrown brands have more than $1 billion in sales each. Market is clearly moving from unorganized to organized, and even if you look at the numbers, they seem to validate it. So in last 5 years, top 15 brands in India have compounded at 24% CAGR in sales versus industry growth of mere 6.5%. We have a lot of listed players in this industry. I've named some of them here. Arvind and Aditya Birla Fashion are the largest ones. Next is furniture. The industry size is 90,000 crore, growing at very healthy rate of 15 to 20%, and the share of unorganized is mammoth 85%. I want to play a video here which will show the pain point for a customer when he wants to customize this at home.
अरे यार, हफ्ते भर की तो बात है, थोड़ा तो एडजस्ट करना ही पड़ेगा ना। थोड़ा टाइम लग रहा है, पर तुम क्राफ्ट्समैनशिप देखना। मटेरियल खत्म हो गया है, कल परसों तक आ जाएगा।
Stop suffering and leave the hard work to us. Choose from the largest range of furniture from pepperfry.com. Happy furniture to you.
So this really sums up what I'm trying to say really well. In terms of organized players, we have Godrej and Boys, Durian in the traditional wood-based furniture. In plastic furniture, we have a couple of listed entities, Neelkamal, Wimplast, and a lot of new players in e-commerce. So the ad which we saw was of Pepperfry. There is Urban Ladder, and these guys are really trying to catch this trend of shift towards ready-made furniture and movement from unorganized to organized guys. Diagnostic is a 38,000 crore industry, growing at 16 to 18%, and almost half of it is unorganized. Now, when I say unorganized here, I only mean the standalone labs. So, organized would have chains like Thyrocare, Dr. Lal, and also the hospital-based labs. Now, those two put together is about 50%, and the other 50%, which I'm calling unorganized, are only standalone labs. Here, what's really driving the shift from unorganized to organized are a couple of factors. One is the pricing. So I remember I used Thyrocare services first time in 2013, January. And if I recall right, I had gone for a package called Arogyam 1.3, which had some 62 tests, and it costed me about 1300 rupees. Now, this also had vitamin D test. out of curiosity, I went to my neighborhood lab and I asked for the charges. Vitamin D test alone cost 1500, and the quote for all 62 tests was 4500 rupees. Contrast that with 1300 charged by Thyrocare. So clearly, in terms of pricing, there's a huge difference. In terms of convenience too, I had booked this test at midnight, and next day morning at 9 o'clock, the technician had come to my doorstep, took the sample. Same day evening, I'd got the reports mailed to me. So I think in terms of pricing, in terms of convenience, the value proposition offered by organized player here is far superior, and over time, this should drive lot of market share from unorganized to organized. We have a couple of listed players from here, Thyrocare and Dr. Lal. SRL is expected to get demerged from Fortis and get listed separately soon. Next is plywood. The industry is worth 18,000 crore, growing at 8%. 75% of it is unorganized. So last year I was renovating my house, and just out of curiosity to get that experience, I went to market and searched for plywood. That I wanted to see how's the process. Now, honestly, there is no way a layman like myself can figure out and judge the quality of plywood. So from 40 rupees onwards, you had plywood going up to 150, 200 also. And the proposition is that this is termite proof, this is waterproof, this is this, this is that. But how do I know? So in terms of search cost, in terms of inability to judge the quality, it's a big issue, right? So, and whenever that is the case, consumers tend to move towards familiar brands which they can trust. On the supply side, there are a lot of interesting things happening. So since 2000, I doubt any new player has entered the market, because Supreme Court had come up with a ruling that no new licenses will be issued. Of course, a lot of issues are there, environmental protection and all those things. Secondly, in India, a lot of unorganized players were importing raw timber from Myanmar, putting a nice veneer on it and selling it in the local market. Now that has completely stopped, because Myanmar last year had put an export ban to India. Now the organized players, like big players like Century Ply, Green Ply, these guys are going there, setting up shop and exporting finished product to India. But the unorganized players cannot do that, right? And finally, on the entry level plywood, which costs 40-50 rupees a square feet, MDF is incrementally taking a lot of market share. So you have a situation where entry level 40-50 rupee plywood is moving towards MDF, and if you're buying a mid end for 70-80 rupees, you might as well just upgrade to 90 and 100 and buy a Green Ply or Century Ply. So the mid guy would get squeezed. The entry level is anyways moving towards organized, which can faster this process of shift from unorganized to organized. These are some of the organized players in this space. Hair and beauty care is a $1 billion category, growing at 15% per annum, and share of unorganized is mammoth 80-85%. Now here, when I say unorganized, I mean mostly standalone dermatologist stores. Again, search cost is very high. How do you know whom you want to go to? So if you have a familiar brand name, and if you know somebody who has gone there, or if the same store is there in different cities, so wherever you move, you have that store which you used to go to in your previous city, that would really give some comfort. So in terms of organized players, we have a very few players till now. There is one Kaya which got demerged from Marico, and that's listed. VLCC is expected to get listed soon. The next is eyewear. When I was preparing for this presentation, I really got surprised to know that this is such a big category. So the category is worth 43,000 crore, growing at 20-25% per annum, and the unorganized is 75% of the category. Now there was a WTO research done which literally said half of India needs vision correction. That's a huge number. That's 55 crore Indians have vision issues. Titan I Plus was among the first organized players to identify this market. Later on, Reliance also entered this, and the most recent player is Lenskart, who's also opening brick and mortar stores everywhere. This is an interesting category I came across. So if you talk about pulses, in India, the market is about 20 million ton. We produce 16, 17 million ton locally, and rest is imported because of the shortfall. So if you assume 100 rupees per kg, the market size is 2 lakh crore, and it is the largest largest category out of all which I'm going to cover. Growing at about 4-5%, but still I covered for two reasons. One, the size of the industry is huge, 2 lakh crore, and 98%, which literally means almost entire category, is unorganized. Now the picture actually shows how almost all of the Indians buy pulses loose. So you go to the shop and there'll be loose pulses, or he would have put it in the packet, but there's no brand. It's all white label stuff at the end of the day. Tata was among the early players to identify this. So in 2010, under Tata Chemical, they launched a brand called I Shakti Sampan Dal. Later on, M&M entered it last year with New Pro. There are a lot of regional brands, Lakshmi, Rajdhani, Mangatram, Nandi. Look at what Tata is promising with its I Shakti brand. So it says it doesn't have any added colors. There are no chemicals. It is unpolished. So when you clean it, you're not going to find any artificial stone powder or oil creeping out of it. It's packaged under most hygienic conditions. It is processed under most hygienic conditions. So it is untouched by human hand. It is 100% laser sorted. It is machine cleaned and graded. And what it means is that you can open the pouch and it's ready to prepare. It does not need any washing. Now I believe when the pricing is similar, Tata is also selling at about 100 rupees a kg, I believe. When the pricing is similar, such a brand proposition is going to make more and more sense to middle class of India. Right, and numbers also say the same thing. So in only 5 years, Tata is already doing about 400-500 crores turnover here, and it's growing at 60% CAGR. Spices is also similar category, again growing at only 4-5%. But why I included it here was one, huge size of the industry, 40,000 crore, and second, share of unorganized, which is very high at 85%. We have some very interesting organized players, Catch of Dharampal Satyapal Group, Everest, MDH, but unfortunately all of them are unlisted. Tata, like Pulses, also identified spices as a huge category and growth driver. So they launched their Sampan brand for spices also. This is one of my personal favorites. The industry is not very large, only 3,000 crore, because this started only in 1984 when Apughar was the first park that came up in India, followed by SL World in Mumbai in 91 and then Nico Park in uh, Kolkata. So the industry is growing at 20% and share of unorganized is 75%. So there are 150 parks in India today, out of which only 16 parks are large parks. And when I say large parks, I mean more than 40 acres. The other 130 odd parks are about 10-20 acre, would have just 5, 7, 10 rides, ticket prices of 150-200 rupees, and they would be serving a small radius around them, right? Population living in small radius around them. Think about it. Why did these parks come up? So somebody had land and didn't know what else to do with it. He didn't want to sell it. The undying love of land in Indians, for that matter, everywhere. So he did not want to part way with the land. He just came up with an amusement park. So he was not a serial entrepreneur and he wanted to grow and professionally run this business. No, it just came up. Or there could be other incentives to run a park because it's a cash business, so he'll give you entry and all of that. So there's hardly any player in India who wants to do it professionally and grow it. Of late, couple of such professional players have emerged. Wonderland, Ad Labs, both of them are listed. Now contrast that with China. China's amusement park industry is worth $3.3 billion. There are 850 parks in China. And what really is fascinating Another 2,500 parks are coming up in China over the next 4-5 years at a cost of more than $50 billion. Some parks alone are costing more than $5 billion each. Next is cold storage, an industry which is worth 15,000 crore, growing at 20% per annum, and share of unorganized is 94%. I can think of so many industries which are growing very fast, and all of those need cold storage. Think about packaged food, quick service restaurant like Jubilant Foodworks, Domino's, Pizza Hut, McDonald's, pharma, confectionaries, and any other item which is perishable you can think of. Now, as these industries grow, they're going to need more and more cold storage. And as organized players in these industries grow, they also would like to deal with one player which has a national footprint. Now, there's hardly any in India except Snowman. So imagine if some companies in 20 different states and they have to deal with different players in different states, which is a very painstaking process. And this is an offbeat category because there's just no listed player here. It's an industry worth 5,000 crore, growing at 15% per annum, and the share of unorganized is 75%. The interesting part here is that Motilal Oswal's private equity arm invested 90 crores in 2015 in Kurlon, which is the largest organized player in this industry, followed by Springwell, Sleepwell. I could come across one company which has some presence in this category, Nilkamal. So they, I think, identified this couple of years back that this is a growing category and mainly served by unorganized guys. But it's too small in the overall scheme of things. They have some about 1,800 crores turnover and only, I think, 30-40 crores come from mattress. Thanks to Talwalkar, most of us would be familiar with this space. So it's an industry worth 9,000 crore, growing at 15-18% annual rate. Share of unorganized is very high here, 90%. And you only have one listed company here, Talwalkar, but other organized players which are not listed, Gold's Gym, Snap Fitness. Now I'm covering some categories which are widely known thanks to some multi-baggers these spaces gave in last 3-4 years. So sanitary ware and bath fittings, most of us are aware it's a huge category, $1.5 billion, growing at 12%. Share of unorganized is 50%. So Sarah, Hindware, a lot of these companies have given amazing returns in last 4-5 years. And though because real estate has slowed down, these categories have also slowed down. But an important takeaway from this slide is that since share of unorganized is still so high in this category, organized players can outpace the industry growth of 12% for a fairly long period of time. So is the case with ceramic industry. So it's an industry worth 24,000 crore, growing at 12%, and share of organized is still 50%. There's a lot of consolidation that has happened in this industry over the last 10 years. So if you see the top players, Kajaria, Johnson, Somani, Asian, Varmora, these top 10 together command some 45% share in the total industry today. But on the other hand, there are still 700 unorganized players, out of which 600 are based out of Morbi, Gujarat. And I think over time, the viability of these small scale operations are going to be really challenged. And I see a lot of consolidation in this industry too in favor of the top 10 players. Air coolers is another interesting category, and thanks to Symphony, we all must be aware of it. Industry size is 3,000 crore, growing at 14%. Share of unorganized, 80%. So there is Symphony, which is a pure play air cooler player, and then there are a whole host of other players which have launched their coolers in last couple of years. But Symphony commands 50% of the organized market share. And there are many more. So as I said in the beginning, the list is not exhaustive. Think about auto ancillary replacement market. Because of taxes, in a lot of states, you have a huge replacement market, which is largely catered by unorganized sector. Think about tour and travel, think about confectionery, real estate for that matter, and a lot of other categories where this trend can play out, where with the categories which are currently dominated by unorganized guys. I want to discuss a case study. So until 1980s, paints used to be a category which was like a commodity. Why? Because the consumer would not have high engagement in the purchase decision. We would just ask our painter to get the paint, and painter in turn would go to the market and buy one for us, right? Over time that changed, and a big enabler was tinting machines. If you've ever been to a paint shop, you would have seen it. Uh, you are given a shade card, you choose the shade card, and the guy puts the number on the computer, and then the machine mixes it and manufactures it there and then for you, then and there for you. So the dealers who took tinting machines of organized players, of course, would no longer be interested in selling other stuff because this gave you so much option. And because of brand pull and a lot of advertisement expenditure done by these organized players, there was a huge shift from unorganized to organized. But look at the numbers. So in 1980s, the industry size was small. These are of course estimates. It was less than 2,000 crore. Unorganized was more than half of it, and a lot of small players were there. Hundreds of small players, and market shares were very fragmented. Fast forward 20 years, industry size trebled. Share of unorganized got reduced to 40-45. And how is it today? The industry is worth 40,000 crore. The share of unorganized is down to 25%. And look at it. Top 5 players account for 61% market share. Look at the consolidation that has happened in this industry over last 5 decades. Asian Paints alone has 30% market share, followed by Berger, Nerolac, Dulux, and Shalimar. GST is a big enabler of this consolidation wave. Today, organized players put together pay an indirect tax of as high as 28 to 30%. With GST, this is expected to come down to 18-20%. So 10% costing will go down for organized guys. Secondly, today, if you are in 10 different states, you would have 10, it's like you are in 10 different countries because the tax structure is different across states. So you would have 10 different warehouses, and inventory management is a daunting task. So I met Phoenix Cable last year, and I was discussing the impact of GST. And it was interesting to know that they have 24,000 SKUs and they have 22 different warehouses because they are in 22 different states. Now imagine having 24,000 SKUs present in all the 22 warehouses all the time, the kind of money it blocks, and such a difficult supply chain management. With GST, this is going to improve a lot. And finally, logistics costs. So in India, the typical logistics cost for a corporate is about 16 to 18%, compared to global average of 6 to 8%. This is expected to come down once the supply chain is improved. Contrast this with the negative it's going to do for unorganized players. So any meaningful player, right, in terms of turnover, more than a crore or 2 crore, and is part of value chain, the minute he comes in, becomes the part of value chain, it's a binary situation. Either you pay the tax or you don't. And if enforcement is good, they would have to pay. And once they pay, they would have to straight pay 18 to 20% GST. Now, for organized players, the costing is going to go down by 10-15%. And for the unorganized guys, it's going to go up by 20%. And that 30, 35, 40% gap which exists today in pricing is going to get closed. And once the pricing for unorganized and organized is just 5-10% here and there, I see that there is a very high probability majority of the consumers are going to prefer a brand, a label which they are familiar with, which they can trust, which will facilitate the whole consolidation wave. And it's going to take lesser and lesser time. It's not going to take 5 decades like it took for Asian Paints category. That process is going to get faster. Now, before I close, I'll briefly discuss how the consolidation wave I've discussed is different from value migration. So value migration happens when one category benefits at the expense of other category. So from wired, we move to wireless, from scooters to bikes, and now scooties. That is value migration. So the whole category grows faster. Whereas in consolidation wave, within a category, the market shifts from unorganized to organized. So the growth is higher for organized guys, and in effect, from inefficient players, it shifts to efficient players. With rising GDP, rising per capita, rising disposable income, I see, because of aspirations, higher engagement in buying decisions. And once that happens, there's going to be a huge preference for what you know, what you understand, what you aspire for in terms of brands. It happened in developed nations, it is happening in China, and I see no reason why it should not happen in India. And though the direction is clear, the timing is not. For some industries, it might happen in the next decade. For some, it might take longer. So to summarize, consolidation wave plays out only once, and we are lucky to be right in the middle of it. A 20% sales growth for next 7 to 10 years is realistic for a lot of companies in many industries. We should be on the lookout for pure play small and mid caps in these industries which can exploit this opportunity profitably. Now that's an important point. Sales growth might not necessarily convert into profitable growth, right? So it might not flow to the profit. So that's the important point which we have to take care of. While looking for such sector, for such companies, we have to make sure that it's a profitable growth. Finally, it might be okay to pay up for such opportunities because there is longevity and there's a clear trend. Thank you.